Welcome to the ProTicker Deep Dive. Today we are strapping in for the 2025 market year in review. And wow, if you thought the markets couldn't get any more volatile, well, think again. This year really tested every investor's resolve. It served up this huge political shock, only to ultimately reward conviction and patience in the most dramatic way possible.
It was a year defined by whiplash. Just pure whiplash. The S&P 500 delivered, around 17% for the year? But that final number, it just hides the chaos that got us there.
Right.
So our mission today is to unpack the key drivers. You've got President Trump's sudden tariffs, the Federal Reserve's sharp, really crucial pivot, and that unstoppable AI boom. To understand why the market survived a massive mid-year crash and still soared to record highs.
Okay, let's unpack this because the foundation, it looked deceptively strong coming into 2025. We were already riding a pretty rare wave, building on back-to-back double-digit returns from 23 and 24.
That's right.
So there was this cautious confidence, but the market was running hot, and frankly, it felt primed for some kind of shock.
And that shock arrived with, brutal efficiency on April 2nd.
Our sources call it Liberation Day, and it's when this new trade policy just hit the markets like a wrecking ball.
Absolutely. The details of the tariffs that day were just staggering in their scope. We saw announcements of up to 60% on Chinese goods.
60%?
Yeah, 25% on imports from Canada and Mexico, and a 10% baseline slapped onto almost all other trading partners. This was immediate and, in modern history, completely unprecedented. And it was like throwing a huge handful of sand into the gears of global commerce.
And the market reaction was just pure psychological and technical meltdown. This wasn't a small correction.
No, this was capitulation. It was truly brutal. The Dow fell 5.5% in a single session.
Wow.
The S&P 500 dropped nearly 8% over 2 days. And the more specialized indices like the NASDAQ and the Russell 2000 for small caps, they both just plummeted into bear market territory.
So down more than 20% from their highs.
Exactly. Fear indices, like the VIX, they surged to pandemic-era levels, and the selling was global. Europe's CSTOXX 600 fell over 5%.
Economists were instantly sounding the alarm bells, right? Forecasting recession, stagflation. They pointed out that the effective U.S. tariff rate jumped overnight from 2% to 18%.
Which is the highest level since 1934.
Unbelievable. The consensus was that this would cost the average household something like $2,400 a year. The narrative just instantly shifted from strength to terrifying policy-driven doom.
And that stagflation narrative was based on that combination of rising costs from tariffs and a slowing labor market, which was already showing some signs of fatigue. It created a really unsettling environment.
So here's the key question for you, the listener. What does it tell us that this whole narrative shifted from impending doom in April to all-time highs by December?
It tells us that the crisis was fundamentally driven by policy uncertainty and fear. It wasn't a collapse in the true economic fundamentals. The fear was real, sure, but it was centered around a political risk that, it proved negotiable.
But hang on, the fear was real, yet the recovery was based on just a simple 90-day pause.
Yeah.
Wasn't that essentially betting on a political outcome? Which is, highly risky.
It was a risky bet for sure, but I think investors realized pretty quickly that corporate earnings hadn't suddenly vaporized. The sharp V-shaped recovery was really based on two things. First, policy uncertainty is just inherently unstable and usually temporary. And second, the underlying corporate engine was still running just fine. And President Trump signaled flexibility pretty fast, pausing tariffs and carving out tech products. By May 9th, it was official.
And the recovery timeline, if you look at the chart, it was just astonishing. Exactly 5 weeks after the tariff announcement, on May 13th, the S&P turned positive for the year. From those April lows to the December highs, the index gained roughly 35%. So what metrics should institutional buyers have been watching to know this was an overreaction, not a collapse?
They were watching margins. Corporate earnings proved incredibly resilient. Companies just held up their operating margins better than feared. They adapted almost immediately through price increases, cost management. Investors realized the tariffs were friction, yeah, but not fatal to profit growth.
And that resilience gave the central bank the cover they needed. The real macro catalyst, the rocket fuel for the rest of the year, wasn't just corporate strength. It was the Fed.
Oh, the Fed pivot was arguably the single most important event of the year. They gained confidence that inflation was moderating, and they saw the potential for a tariff-induced slowdown, so they pivoted sharply. They delivered 3 consecutive quarter-point rate cuts, bringing the Fed funds rate down to 3.75% by December.
That's the lowest since 2022.
It is. And this easing, it supported stocks, and crucially, it helped catapult gold to its record highs. And, we also had a tailwind from new tax cut legislation passing Congress, which just gave another boost.
So while macro policy was the recovery mechanism, tech stocks were the real engine of growth. The dominance of large tech, driven almost entirely by AI infrastructure, didn't just continue in 2025, it accelerated.
Oh, yeah. The AI capital expenditure engine was in fifth gear all year long. The semiconductor kings were just unstoppable. NVIDIA, the leader in AI chips, surged roughly 85% for the year. It became the world's first $5 trillion market cap company.
5 trillion. That number alone just captures the urgency of the AI race.
And it was justified by staggering demand. I mean, NVIDIA's Q3 revenue alone hit $57 billion, up 62% year over year. This was driven by a genuine frantic race among all the data center operators to build out their AI infrastructure. We haven't seen that kind of pace since the late 90s dot-com boom. This wasn't hype. These were real chips being sold and delivered.
Yet even within that mega-cap tech group, we saw this stark divergence that proves, size doesn't guarantee returns. Amazon severely disappointed, gaining only 4% for the year. Why did it stumble so badly?
Amazon faced a multi-front problem. First, their AWS cloud division saw more competition. Second, their core retail arm, unlike the chip makers, felt real margin pressure from those tariffs and logistics friction. It was a sharp reminder that performance is earned, quarter by quarter, and the AI race didn't lift all boats equally.
Right. And conversely, the communication services giant, so Google and Meta, they staged a huge comeback. How do they pull that off?
They executed an expert pivot. Instead of just focusing on expensive consumer-facing chatbots, they focused on integrating AI into their core revenue drivers, their ad platforms. This AI implementation just dramatically improved targeting, reduced fraud, and increased the value of their ads. That focus worked spectacularly, sending both stocks soaring.
And looking beyond those huge tech names, market breadth seemed healthier this year too, which suggests the rally is more sustainable than just a handful of winners, right?
Absolutely. The rally broadened out significantly. Q3 earnings were stellar. 81% of S&P companies beat estimates. Overall earnings growth hit 13%. And crucially, the Russell 2000, the small cap index, actually outpaced the S&P 500 for a lot of the year. That signals confidence was flowing out into smaller, more economically sensitive sectors.
Okay, now let's shift gears to talk about the year's undisputed biggest winner. Gold. The precious metal surged an astounding 65% for the year. It hit an all-time high near $4,349 an ounce. It started the year near $2,670. That's a massive move.
It was an extraordinary run, and it was justified by four reinforcing drivers that just stacked on top of each other. First, the safety hedge. That April tariff crash caused a massive flight to quality and portfolio insurance.
Okay, that explains the initial spike. But why did it keep running so strongly all the way through December?
Because the next three drivers provided long-term structural support. Second, central bank demand was relentless. We saw China, Russia, India, the BIS all accumulating physical gold reserves at a record pace. This isn't retail demand. This is sovereign entities diversifying away from dollar risk. It provides a structural floor under the price.
That's a huge factor.
It is. Third, the Fed's rate cuts in the fall reduced the opportunity cost of holding gold. When rates on cash and bonds drop, non-yielding gold becomes way more attractive.
Got it.
And fourth, all that tariff uncertainty raised questions about U.S. fiscal sustainability, which led to a weaker dollar. A weaker dollar makes dollar-priced gold cheaper for foreign buyers, so it fuels global demand. Goldman Sachs had a target of 3,700, and we just blew past that. We hit 4,000 in October.
That 65% gain just validates the importance of portfolio insurance. A standard 603-30-10 portfolio stocks, bonds, and that 10% in gold was spectacular this year because gold perfectly countercycled that equity shock.
It was the perfect countercyclical asset when policy risk peaked.
Speaking of those tech valuations and that rapid recovery, what were the technical analysts seeing by year-end that suggested caution for 2026?
Well, the technical picture for 2025 is fascinating because it told two different stories. April was a textbook example of capitulatory selling, pure panic. But the key indicator, the S&P 500's 200-week moving average, it held. That 200-week is often seen as the ultimate line in the sand, and institutional buying emerged aggressively right at that low.
The big money stepped in when everyone else was screaming. The classic move.
Exactly. But by December, with the S&P trading near 6150, technicians grew a little puzzled. Valuations, especially on the Nasdaq, were genuinely stretched. The index kept inching higher, but momentum was positive but slowing. It suggests the market is kind of riding on fumes of optimism heading into the new year.
So what are the biggest risks for 2026? It sounds like we're walking a tightrope on these high valuations.
The core risk is still that valuation bubble in tech, specifically in semiconductors. If that AI capital spending slows down, or if companies realize the ROI isn't there, we could easily see a sharp correction, maybe 20 to 30% in the Nasdaq. And that would ripple across the whole S&P.
And we still have the lingering threat of inflation and tariffs actually showing up in the real economy, don't we?
Yes. The full impact might show up in consumer prices in 2026, forcing the Fed to reverse its rate cuts. A tightening Fed would be devastating to high multiple tech stocks. Add to that the warnings from the labor market, where job growth is expected to be the weakest since 2010, and you have significant uncertainty.
So after this whole roller coaster ride, what's the core behavioral lesson of 2025 for the individual investor?
I think the year fundamentally separated investors from traders. Panic selling in April was severely punished. Conviction and patience were rewarded with that 35% rally off the lows. It's easy to say buy when there's blood in the streets. But when the Dow falls 5.5% in a day, the urge to sell is immense. The lesson is that when the fear is based on policy uncertainty, which is inherently unstable, rather than a true fundamental collapse, the market often overcorrects. And that presents a massive buying opportunity. You have to understand the source of the fear.
So 2025 proved that the best time to buy is often when everything feels terrifying, especially when the underlying fundamentals like earnings and Fed policy haven't completely collapsed.
Exactly. The market's willingness to shake off a crisis and climb to new highs despite all that uncertainty is the defining feature of the year.
The bet for the future isn't about predicting direction, whether the S&P hits 8,000 or mid-7,000s. The real bet is that volatility will continue to create opportunity for those who maintain conviction and dry powder. That's just cash reserves ready to deploy when the market panics again. Because history proves volatility doesn't disappear, it just changes form. See you all in the next Pro Ticker Deep Dive.